Welcome to The Explainer. Today, we're taking a pretty wild journey from real-world financial dominance straight into a fascinating computational strategy simulation. We're looking at fast retailing, the parent company of the global apparel giant Uniqlo. Right now, they're posting absolutely record-breaking financial numbers. But here's the thing. When a retail empire has already conquered so much of the globe, the boardroom inevitably has to ask, okay, where to next? So, we're going to explore a theoretical, highly data-driven what-if scenario built by DBbun LLC. It's a simulation that models a potential Uniqlo expansion into Israel. It's a market that offers a really compelling mix of high consumer wealth, but as we'll see, it comes with some incredibly complex geopolitical risks. Here's our roadmap for today. We'll start with Unclo's record-breaking reality, look at their next big move, and then actually build our expansion simulator. After that, we'll run through 5 simulated futures, compare those simulations to reality, and wrap up with the strategic takeaways and risks. Let's get right into it. Section 1. Uniqlo's record-breaking reality, FY 2026 first half actuals. Before we dive into the what-ifs, we really need to anchor ourselves in absolute reality, because let's face it, the foundation of any good simulation is rock-solid real-world data. And fast retailing's consolidated revenue for the first half of FY 2026, it surged to a massive 2.0552 trillion yen. That is a year-on-year growth of 14.8%. Uniqlo International was a huge driver here, with revenue up 22.4%, fueled by big flagship store openings worldwide and seriously high growth across North America, Europe, and Southeast Asia. And that top-line growth translates to just phenomenal bottom-line health. Consolidated business profit jumped by an astonishing 28.3% year-on-year, hitting 386.9 billion yen. I mean, they aren't just selling more clothes, they're selling them incredibly efficiently. The company even went ahead and revised their full-year profit estimates upward. So we're looking at a company with the capital, the momentum, and the operational excellence to make some really bold international moves. Which brings us to Section 2, the next big move, geographic diversification. And when your core markets are performing this well, your corporate strategy teams immediately start looking at the white space on the map, right? Geographic diversification is absolutely essential if you want to maintain double-digit growth. But expanding into new, complex regions, like the Middle East, presents some really unique variables. Now, fast retailing is actually already feeling the logistical ripples of the Middle East. Just look at this quote. As they noted in their own FY 2026 results summary, current estimates already incorporate impacts like higher transportation costs due to the regional situation. This perfectly validates why we're exploring this specific region today. The friction is literally already a reality for their supply chain. Our simulation is just asking, well, what happens if they establish a direct retail footprint right in the middle of it? Let's move to Section 3, building the expansion simulator, calibrating the synthetic data. To answer our big expansion question, we turn to a computational model developed by DBbun LLC. And guys, this isn't just guesswork. This simulator uses deterministic growth equations and stochastic shocks, but it anchors all the model parameters to fast retailing's actual FY 2026 first half data. Now, the core rule governing their whole simulation is this, the geopolitical-risk index. Think of this as the master variable. It ranges from 0, meaning zero risk, all the way to 1, meaning maximum risk. And this index isn't just some abstract conceptual idea. In the model, it mathematically dictates very real business constraints. It drives up logistics costs, it triggers sudden consumer boycotts, and it penalizes overall revenue. It is literally the engine of uncertainty in our simulation. Check out the inherent tension built right into these foundational parameters. On one hand, you have a highly attractive market. We're talking a population of 9.7 million with a GDP per capita of $55,000. That is a high-income consumer base, perfectly suited for a brand like Uniqlo. But on the other hand, look at the baseline geopolitical risk. It's set at 0.35, which reflects a moderate, ongoing regional conflict level. So the simulation basically challenges the model to achieve fast retailing's actual target gross profit margin, that 54.1%, while constantly navigating that persistent 0.35 friction. All right, Section 4, simulating 5 futures. From cautious to aggressive. Using this sandbox, the simulator projects 5 distinct parallel timelines over a 10-year horizon, and they range from a very cautious entry all the way to a massive flagship-led aggressive expansion, down to a high geopolitical risk escalation, and even a de-escalation upside driven by regional peace. Just looking at the top-line growth here, notice the stark contrast. The aggressive flagship strategy and the de-escalation upside scenario really push annual revenue up there, heading toward the 45 to 55 billion yen mark by year 10. But then, look at the high geopolitical risk scenario. Here, conflict escalation triggers a brutal 20% revenue penalty and severe boycott risks. It entirely flatlines growth, keeping revenue barely above 10 billion yen a full decade later. That's a huge gap. But let's shift to the bottom line, because that's what investors really care about, right? Here we can see exactly how long it takes each timeline to break even and generate real yen. In almost every scenario, the initial years require some heavy capital expenditure for store build-outs and brand awareness campaigns, which means profits hover near zero. But by year 5, the de-escalation and aggressive scenarios really start pulling away, eventually generating nearly 8 to 10 billion yen in annual business profit. Meanwhile, the cautious base case just plods along steadily, and that high-risk scenario, it barely scrapes above the break-even line. This really paints a picture of extreme volatility when we sharply contrast the worst-case constraints against the best-case peace dividend. In the high-risk scenario, the geopolitical risk index spikes to 0.65. This forces store openings down to just 1 a year, drives logistics costs up to a painful 11% of revenue, and creates a massive 35% probability of consumer boycotts. In stark contrast, the de-escalation upside drops that risk index all the way to 0.10. Logistics normalize to 4%, boycott risk practically vanishes to just 5%, and Uniqlo can comfortably open 3 stores a year, really accelerating their brand momentum. So, what does this all mean for market dominance? Well, by years 7 and 8, the de-escalation and aggressive strategies successfully push Uniqlo toward the 8% market dominance mark. The cautious baseline, opening just 2 stores a year, lags significantly behind. It takes the full 10 years just to reach a 5% market share. Moving on to Section 5, comparing simulation to reality. The benchmarks. Okay, time for a reality check. Synthetic data is only useful if it actually makes sense in the real world. Let's bring these projections back down to earth by benchmarking them directly against fast retailing's actual massive global segments. This is kind of the aha moment of the explainer. You see fast retailing's actual annualized revenue for H1 FY 2026. Uniqlo International is pulling in roughly 2.4 trillion yen, and then you see our simulated Israel entry in year 5 and year 10. The revenue scale is absolutely tiny compared to the rest of the empire. It's barely a blip on the consolidated balance sheet. But wait, look closely at the profit margin. Despite the much smaller revenue scale, the operational efficiency is right on target. Tracking the simulated business profit margin over 10 years reveals that fast retailing's actual Uniqlo International profit margin benchmark is 18.8%. In our simulation, the base case and aggressive scenarios endure some heavy initial losses, for sure. But by years 6 and 7, they systematically align with that global standard, stabilizing around 17 to 18%. So the model proves that, barring severe conflict escalation, the fundamental unit economics of this market actually work. Finally, Section 6, Strategic Takeaways and Risks, the verdict. Let's synthesize all this complex, multiverse data into some core, actionable strategic lessons for business leaders. Like, what does this simulation actually teach us about entering a high-reward, high-risk geopolitical environment? Well, here are the quantifiable realities. First off, geopolitical risk creates a massive penalty on logistics, eating up to 11% of revenue when supply chains are forced to reroute. Second, the persistent threat of boycotts in a high-risk environment heavily discounts the long-term value of the investment. Third, regardless of the scenario, an unavoidable multi-year ramp-up is required just to reach fast retailing's target 54.1% gross margin. Success here is definitely not overnight. Fourth, while an aggressive flagship strategy builds fast brand awareness, it severely magnifies early financial losses. And finally, if regional de-escalation actually occurs, it provides a remarkably fast and profitable path to a commanding 8% market share. Which leaves us with this final, really provocative strategic question. Is the high-income potential of this specific market worth the quantifiable geopolitical risks and logistical hurdles? For a retail giant like fast retailing, already posting 2 trillion yen half-years, is this the right place to deploy capital, or is the friction simply too high? It perfectly captures the complex, high-stakes trade-offs of international business expansion. Thanks so much for joining me on this deep dive into the simulation.